Hello, I'm Paul Savage, Certified Business Intermediary with Pacific Business Brokers. Quite often buyers insist on having some portion of the purchase price of a transaction being financed by the seller of the business. Sellers providing financing may get a speedier sale and a sale at a potentially higher value. Today's segment addresses seller financing and promissory notes. A promissory note is a written, dated, and signed two-party document containing a promise by the buyer to pay a definite sum of money to the seller on demand or at a specified future date. A note will contain key elements: the amount, interest rate, the term of the loan, repayment dates, and repayment amounts. It may also contain security provisions. Let's look at these things individually. First, the amount. Sellers will want to ensure that the amount of the note does not exceed the fair market value of the assets in the business that are being used as security for the note. The interest rate. The interest rate can be used strategically by providing higher or lower rates than market rates or bank financing rates. A lower rate than market is appealing to purchasers, while a higher interest rate is appealing to sellers. Repayment risk and security. Sellers should insist on security being provided by the buyer. This security may include the buyer's personal guarantee, pledging of the company's assets, insurance coverage over the life and health of the purchaser in favor of the seller, financial reporting, and restrictive covenants such as the prohibition against the sale of the business. To help assess risk, sellers should request the purchaser provide a personal net worth statement and a credit report. Get key net worth items verified. For example, a title search on the purchaser's home will confirm who owns the home and who has mortgages or other charges registered on title. The term of the note is important. The seller and the buyer will both usually want the note paid off as soon as possible, but for different reasons. The seller will want to collect the money for the business to cash out as soon as possible in order to minimize the risk that the money will not be paid. As a seller, your biggest fear in accepting a note for the business is that the buyer will stop making payments, having run the business into the ground. The buyer, on the other hand, wants to pay off the note as soon as possible so that he can realize the maximum financial benefits of owning the business. For these reasons, most business promissory notes have a time frame in the range of 2 to 5 years with a tendency towards the shorter time period. Repayment schedule. Monthly repayment is most common. Buyers prefer monthly repayment because it ensures principal repayment occurs immediately. The terms of the promissory note impact the overall value of an offer. In other words, the value of the offer isn't just the price as written in the contract. The true value of the offer includes a valuation of the terms of the promissory note relative to market rates. To fully understand the impact a promissory note has on the value of the offer, we recommend that you work with a certified business intermediary. Thank you for joining us. I am Paul Savage.